Hi, good evening, everyone, and a warm welcome to our LLF Let's Learn Futures webinar series. We are thrilled to have each of you here with us today. Now, before we begin, please confirm in the chat box by typing yes or type in 111 in the chat box if you can hear me clearly so that I know everything is running well on your side and also on my side. So if you're able to hear me and see my slides, please type in 111 in the chat box. All right, great. Thank you very much. Now, today's Let's Learn Futures webinar topic is the power of spread trading, unlocking opportunities in the futures market. This LLF webinar series is proudly brought to you by Bursa Malaysia in collaboration with Excellent. I'm CY Saw, your moderator for today's session. We are privileged to have David Ng joining us to share about how you can do spread trading in Malaysia futures market. As you know, besides trading futures outright, you can also do spread trading. And some of you probably may have heard of spread trading before. And while for some of you, spread trading may be something new to you, which is why our topic for today will be sharing with you about what it is spread trading and how you can take opportunity of this, where David will elaborate on this topic in greater details. So let's get started. I see more people just joined the webinar room. Welcome in. One more time before we begin, one final sound check. Please type in 222 or yes, or give us a thumbs up in the chat box if you can hear me clearly. And if needed, please adjust your volume settings to ensure optimal sound quality. Great, thank you very much. Now, to ensure you can have the smoothest and highest quality video experience, I highly recommend turning off your video camera during the session, as this will help minimize internet bandwidth usage, prevent interruptions, and ensure an optimal learning experience for everyone. Today's session will be divided into two parts. The first part, David will present his sharing. Following that, we will be having a Q&A session where you can ask questions related to today's webinar topic. As you know, there are some improvement in this webinar platform. For those of you, if you are not familiar with this, you need to find the Q&A box here. So how you are able to do that is that, somewhere around at the bottom or the bottom right of your screen, you are able to find that there is three dots. Click onto it, and there you go. You can find what we call as the Slido polling Q&A. As you click on this Slido, there will be a question box popping up. So please submit your question there so that I can pick your question easily. Please do note that, due to high volume of messages in the chat box, it may be challenging for me to spot your questions if you do not use Slido for Q&A. So feel free to type your question in Slido at any point in time during the presentation. As this is the LLF Let's Learn Futures webinar series brought to you by Bursa Malaysia, we have a lineup of exciting topics ahead to help you deepen your understanding of futures trading. Every Tuesday, we will host a new webinar topic in this series, featuring sessions in English, Malay, and Mandarin. Our panel of speakers and experts will share their valuable knowledge and insights, as well as practical strategies related to futures trading. We have many content-packed and informative topics lined up, with more being added regularly. So if you're interested in enhancing your knowledge and skills in futures trading, simply scan this QR code to register. And of course, don't forget to add this session to your calendar so you won't miss any of them. Besides that, we also have the LLF Let's Learn Futures online workshop. This online workshop is specially designed for those of you who are new to futures trading. In these workshops, we will be covering a full set of beginner's knowledge in futures trading. It's a step-by-step guide to help you kickstart your first futures contract. Each session is 3 hours long. The upcoming LLF workshop session will be next month, 5th July, as well as 19th July. So if you're new to futures trading and would like to learn more, you can register for these online workshops. They are entirely free and fully sponsored by Bursa Malaysia. And please note that the attendance is limited to the first 50 online participants, so be sure to grab your seats quickly. Now, before we begin, it's my pleasure to introduce our speaker for today, David Ng. With years of experience in the derivative industry, David is a seasoned expert in this domain. And previously, he served as the head of marketing in Phillip Futures, where he led the team in driving growth and development in the derivatives market. Currently, David is a full-time proprietary trader with Iceberg X, which is a local proprietary trading firm. He brings a wealth of knowledge and expertise to our session for today. So without further ado, I'm delighted to hand this presentation over to David. David, the floor is yours.
Okay, thank you, Siwan. Just allow me to share my slides. Do let me know if you can see my slides in a full screen mode.
Yes, your slides are the same.
Okay, yeah. That's great. Thank you, everyone. Firstly, just like to thank Excellent as well as Bursa Malaysia for inviting me tonight to speak on this topic, entitled "The Power of Spread Trading: Unlocking Opportunities in the Futures Market." And obviously, thank you for the audience for joining us tonight. Hopefully, in the next hour or so, you're able to gain some insights and start your journey in spread trading. Now, just to reiterate what CY has mentioned earlier, a lot of us are very familiar with. When it comes to futures trading, most of us will be focusing our attention on doing outright trading, which means like, if you have a view that the market is going to be bullish, you long a contract. If you have a view that the market is going to be bearish, you short a contract. So that's, that's very focused on outright trading. Now, in today's topic, we're going to talk about spread, which mainly essentially we're talking about price differential between whether it's on the same commodity, whether it's on a different commodity. We will just touch on that. And importantly, we are all just looking at a price differential between these two. And importantly, we are doing spread. There's certain dynamics that you need to understand, essentially, because that's slightly different from doing pure outright trading. And I think hopefully at the end of the session, you probably can gain some ways and insights on how to really navigate the spread market. Now, just to put a disclaimer out, I think what matters as presented here purely is tonight is purely for education purpose. Any opinion is reflected is purely based on my personal opinion, doesn't reflect opinions whether it's from the exchange or whether it's from the organizers. Now, keep in mind, if you are new to futures market, dabbling in futures is a derivative instrument, so therefore it incurs risk. So make sure you have sufficient knowledge. You do speak to a licensed representative from any brokers. There's a license by Bursa Malaysia and Security Commission, before you kickstart your journey in futures trading. I just want to highlight as well, I think this material as presented it's not vetted by the exchange or by the regulators. So keep that in mind, and any opinions being expressed is purely based on my personal opinion throughout the whole session. Now, I think this is what we're going to cover. I think first thing is that, we just want to give you if you're new to spread trading, just want to give you a deep insights on how to really navigate, the spread trading as a whole. I think we are well familiar if you are trading futures for quite some time, probably you're well familiar with trading in the outright market, but spread trading requires certain terminology, certain ways and certain styles to navigate the market. Now, I think when you trade commodities itself is very seasonal. I mentioned this in a couple of webinars or in some of the seminars I conducted. The reason why commodities is so highly sought after by traders itself to trade a particular commodities because the seasonal patterns is actually very prominent. So if you just look at CPO, there's always a period of time or period of the year where you see prices tend to do pretty well, and there's always periods of time of the year that prices tend to become weaker. And these are all quite aligned with how fundamentals are being played out, which I'm going to share with you a little bit more in depth by looking at how fundamentals can play a part or play a role when it comes to doing spread trading. Now, last but not least, I think I get this a lot. People always find it very difficult to understand spread because they always think that it's a very technical, or rather it requires a bit more sophisticated knowledge. I mean, truth of the matter is that spread trading essentially it means price differential between two particular, whether it's the same product, means two different months, contract months, or two different product that's very similar in certain ways. Essentially, you're looking at a spread. I think in certain ways you can apply technical analysis, especially if you are doing the CPO calendar spread, which I'm going to share in the second part of this webinar, which essentially can help you to really navigate the market in a much more effective manner. So, there's always a saying, you can't apply technical analysis when it comes to spread trading. Now, truth of the matter is you can, especially when, in fact, when you look at it, spread markets and you compare with outright markets, spread markets tends to show you more trendy nature. So if you are a trend trader, you apply or deploy trend trading tools. I think when you look at spread trading markets, essentially there'll be a better fix or better fit compared to the outright market, which tends to be more volatile, and therefore, if you're doing trend trading, it may not be that suitable ultimately. So, in certain ways, I think, you can apply technical tools and you can apply trend trading strategies when it comes to doing spread trading. Now, this was just to give you a very basic introduction to spread trading. Now, if you just look at essentially what it means by spread, ultimately, just looking at, buying a particular commodity. If you're talking about inter-commodity spread, you're buying one commodity A and you're selling another commodity B. So it's always it's always a dual application whereby you buy a certain product and you're selling a certain product. So essentially, you're just looking at the spread differential. So the common thing when you look at palm oil, when you're trading palm oil, the next best is always, or rather the rival competing vegetable oil market is always the soybean oil market. So when you talk about inter-commodity spread, so you're comparing palm oil and soybean oil. Now, if you believe that palm oil is undervalued and soybean oil is overvalued, so what you do is that you will buy palm oil and you sell soybean oil. So this is what I meant by trading the spread market between different commodities. So essentially, when you talk about spread, you're talking about relative value between two different asset classes, or in fact, it can be two different time periods. And usually, if you're trading the CPO market space, a lot of spread traders will focus on looking at the time spread, or in other words, it's called calendar spread. Which I'm going to share with you a little bit on that in the next couple of slides. But importantly, I think the concept itself dictates that, when you look at spread, you're merely looking at the relative value between these two. So essentially, I think in terms of risk management is highly more efficient, because the act of buying and selling, it helps to counter react certain risk exposure. Now, if you're doing outright, it's almost 100% risk exposure to a certain direction of the market. Now, for example, if you're doing outright, if you think the market is going to go up, you long a futures contract, you are technically 100% exposed to the market. Now, if you're doing a spread, you're thinking that a spread is going to get wider, or the price differential between two particular months is going to get wider because of fundamentals or because of market forces. What you'll be doing is that you're probably going to be buying a spread, or we call it a bull spread. Now, in that case, once the spread gets wider, essentially you're profiting from it. So really, the act of buying and selling simultaneously helps to elevate the risk. And in fact, it's not so directional. If you compare to doing an outright trading, which is very directional, you are exposing yourself to 100% risk of the market. So essentially, when a lot of people are tempted, or they like to do spread trading, is because the efficiency of managing risk is better compared to just doing outright trading. Now, there's a couple of different types of spreads. So I think a key thing is that what I mentioned earlier, which is very common for a lot of spread traders in the local scene, is that a lot of them will try to do what you call the time spread or calendar spread. So essentially what you're doing is that, for example, the active contract on CPO market right now is September 2025. So if you think that going forward, the spread or price differential between September 2025 CPO contract and October 2025 CPO contract is going to get wider, mainly because of the war that's happening, the tension, the Middle East tension. You expect that September contract should perform much better compared to October. So essentially what you'll be doing, you should be buying September 2025 contract and you're selling October 2025. So essentially what you're doing is you are looking at the calendar or time spread and the price differential between these two different months contract that is on the CPO market. So that's one type of spread that's available in the market to trade. Now, another type is what we call intermarkets. So this also a lot of traders will also access to it. So one, we have in Bursa Malaysia Derivative, we have a lot of listed contracts that is I would say that is closely linked to the CPO market. So obviously we have the main, which is FCPO. We also have the latest edition FSoy contracts, which is based on the Thailand soybean oil contract. So keep in mind, palm oil and bean oil are closely quite related. There's also FIPO, which is an East Malaysia palm oil futures contract that's listed on Bursa Malaysia Derivative. So you can do this kind of interplay. For example, if you're looking at intermarket spreads, if you believe that FCPO is undervalued, So you'll be buying for example, May 2025 SCPO, and you'll be selling the overvalue pair, which is usually common in a bean oil market. So in other words, what essentially you're doing is that you're looking at intermarket spreads between these two particular commodity. Now it's not only constrained to, let's say, SCPO and SY, it can be other examples as well. You can even look at SCPO and to a certain extent, you can even look at grains, SCPO and corn, SCPO and soybean per se, which is listed on the Chicago Exchange. So there's many ways to look at it, but essentially you're just looking at the price differential between two different contracts on different markets. Now we have also inter-exchange. Now, inter-exchange is looking at different listed markets. For example, I think the closest one we can really gather is that if you just look at the Thailand SY contract is listed on Bursa Malaysia Exchange, and you compare with the Thailand soy contract itself, technically you can get a price differential between these two. So they're bound to have very minimal difference, because even though they are similar products but on different markets, they're bound to have certain differences because maybe of the exchange, the exchange currency exposure and whatnot that cause the difference between the two contracts, although they are similar contracts but on the different markets. So there's also spreads that actually capitalize on such opportunity. So I think one good example is just looking at soy and obviously compare that with the soybean contract or soybean oil contract that's listed on the Thailand Exchange. Now, there's obviously a couple of constraints and dynamics you need to take care whenever you're looking at inter-exchange. First thing is that usually, even though they are same product but listed on different markets, they are bound to be they're bound to local constraints. For example, you're definitely going to gain currency exposure. The reason why, although it's the same product, but the price difference is mainly because the exchange risk is quite prominent. Unless you can hedge that risk, usually there's usually a price premium or discount that you have to encounter whenever you're doing such spread or comparing such markets. So inter-exchange spread is less common, but obviously there's also some traders that look at it. So the most common among these three type of spreads, as I mentioned here, is usually the calendar or time spread that most traders will look at it. So just to reiterate again, I think time spread, you're just looking at different calendar months that's listed on the CPO market under Bursa Malaysia Exchange. Now, the essential of spread trading is very simple. Now, if you believe that a spread or the price differential will go wider, normally you believe that the near-month market is going to perform much better compared to the further months in the calendar spread market. So in that sense, you'll usually be buying spread, hoping that the near months will climb up faster relatively to the further month contracts. Now, vice versa, if you believe that the further months or rather the near months are going to perform quite badly because whether it's supply is coming back, or whether there's government involvement in terms of tax tariff, especially in the CPO market. Government regulations, especially when it comes to tax, are very sensitive and it will cause prices to move. So in that sense, people are less, I would say, less optimistic in the front contracts. So in that sense, they'll push front contract prices even lower compared to the further months. So in that sense, you'll be shopping a spread, given the fact that the near month contracts are performing quite badly compared to the further months. So that's essentially how you look at spread and the view of the spread market. Now, these are basically the benefit of trading spreads. I think the major key one, first thing is always, you must understand, if you're doing outright, you're gaining 100% risk exposure. So if you are thinking the market is bullish, you're exposed 100% to the bullish market. But what happens if the market turns to a bearish market? You get 100% risk exposure. Now, if you are doing a spread, the action of buying and selling a particular month of a contract, you are simultaneously offsetting the risk of each other. So essentially, you're just only looking at the differential. In a sense, is giving you less market exposure. And in terms of prices, now if you look at, for example, you look at movement today in a September CPO contract outright, the outright movement easily recorded about 150 to 160 ticks of movement per day basis. Now, if you're trading the spread contract, let's draw an example, September, October 2025 spread contract, you notice that probably the high and low range is only probably about 8 to 9 ticks. So compare 8 to 9 ticks and with 150 ticks, is amount of a difference. So in that sense, essentially, you're looking at spread with a much lower risk and much lower price fluctuation as compared to outright trading, which expose you to much greater price fluctuation, and in certain ways, your risk exposure is much greater. Now, I think secondly, in terms of why a lot of people are starting to look at spread trading as a way to navigate the market is because the margin requirements for spread trading essentially are much lower compared to the outright positions. Now, margins requirements, you do have to get the latest one from the brokers, because exchange do on and off adjust the margins accordingly based on the market condition. But it's important. If you're trading outright positions, normally the margins requirement are between the region of 7,000 to 9,000 ringgit per contract. Now, if you're doing a spread contract, a calendar spread contract, normally the margins required are about 10 to 15% or even 20% of the outright margin. So essentially, you're only paying a fraction of the outright margin. So it makes your margin more efficient, and it's easier entry for those who want to participate in the spread market because of the margin requirements. Now, third benefit is, I get this a lot. A lot of people tells me that, oh, when you do spread trading, you can't look at chart because you can't base on anything. Unlike outright, you can see charts clearly. There's resistance that's very clear. There's support that's very clear. Now, truth of the matter is that, like I mentioned in the beginning, sometimes spreads markets do show you tendency of a trend forming. So when it comes to trend trading, which we're going to see later on, it's actually much easier and it's clearly reflected in a spread market as compared to outright market. So if essentially you can use technical trading strategy and apply it accordingly in a spread market as well. Not only in the outright market, you can do that in the spread market as well. Now, seasonality impact is one great thing. So because if you look at time spread or calendar spread, if you look at CPO on the whole 12-month basis, there's always a period of time where prices tend to be weaker, which is usually coincide around June, July, August, or September period. Which I'm going to share with you why is the reason. And usually the period that's very strong in the CPO market is usually November, December, January, February. So essentially, if you have the view that fundamentals of the market is going to behave in such a way, you can actually position your spread accordingly. So what you'll be doing that you should be selling June contract, July or contract, and buying December or January contract, which I'm going to share later on a little bit more on how we do this. But importantly, because of this seasonality impact, as a spread trading, it can actually help you to capture such opportunity that's in the market. Now, a higher rate of return, that's essentially because the margin requirement is very low. So obviously, when you get a return based on your margin required, it's usually you get a very good ROI. But keep in mind, rate of returns are always double-edged. Again, futures is a leverage instrument. You can gain a lot and you can also lose a lot. So importantly is that, in any trading that you do, whether it's spread, whether it's outright, always manage your risk. If you don't manage your risk well, I've mentioned many times in some of my webinar session is, what will make or break a trader is down to risk management. So if you don't get your risk management right, you technically expose yourself to too much of risk, and eventually you get stopped out from the market. Now, the last bit, spread can be used to roll over position, especially if you're doing outright. You're thinking that because every outright contracts on the futures market has an expiry, and you want to express your view in a longer term basis. Normally, what you do is that instead of you closing your outright position, you actually can use a spread to roll over positions to the next further months in order to express a particular point of view to the market. Now, I highly don't encourage this. Normally, if you want to do this, because if you want to use futures as a long-term instrument tool, it's not so, I would say it's not so optimum in the sense that there's a lot of costs involved, especially roll costs, and also essentially commissions that you pay to your broker. So, if you really want to go long-term view on an instrument, especially on the futures market, it's not ideal. There's always other instruments that you can consider or other related markets that has the same exposure to the particular commodity that you're looking at. Okay, so this is a sample of a spread margin. You look at it, I think the outright margins usually is about 7,000. I think this probably could change in recent weeks because of the volatility of the market. So again, do engage with any of your brokers for the latest margin list. But what is important is that if you just look at essentially this calendar spread that's down here, majority of them are pretty much a fraction of what your outright contract is, between the region of 10 to 30 or even 40%. So in the sense that you definitely get lower margins whenever you trade spread contracts, and that helps individual to optimize their risk management. So in a way, because of the fluctuation of the spread market is much lower, so therefore a lot of traders who trades on the spread market will definitely be more focused on sizing their position based on how many number of lots they can do. Now, so talking about spreads, so what I have here is the listed contracts of all the different calendar months on the derivative exchange. So you can clearly see, if you just look at it, we have contract that's listed until the year 2028. So yeah, almost 2 years forward. Now, obviously, if you want to have a view, if you trade, these are all contracts that you can trade. Now, there's a risk of trading contract that's too far out. For example, if you want to trade, let's say 6-8 months later, or even 1 year later, the risk is that the volumes are very limited. So the bid and ask could be quite wide. If obviously you trade further than that, sometimes there's not much of a quote, because you really can't see things that's happening 1 year later. In fact, with Trump coming in, with Trump 2.0 and escalating Middle East tension, it's so difficult even to see what happens next week. So essentially, I think it's important that with these listed contracts, why I want to show you this is because you can form different type of time spreads accordingly. So right now, obviously the third month contract is the most active. This is not updated, so the third month active right now is September. So you can do a September-October time spread. You can even do a October-November time spread accordingly, and so on and so forth. So you can actually form different calendar months or time spread accordingly based on the listed contracts. Now, keep in mind, exchange, all these calendar or time spreads are exchange listed contracts. So you can get that on the exchange, or even from your broker. So but keep in mind, you can do many derivation. You can do a pair September with November. You can do September and December and whatnot. So essentially, you are just taking a position of a view. One of the contracts should be a very short term, which is the nearest to you. In that case, usually it's the third month contract, which is a September. And another contract usually is the further month contracts. It could be any months. It could be October, it could be November, it could be December. But of course, as you go further into the months ahead, keep in mind volumes are very low. So essentially, you might pay slippage because the bid and ask is actually very wide. So keep that in mind. So a lot of traders, if you are new to calendar spread, your main focus should be on the third month contract, and obviously pair it with the next subsequent month. So in this case, it should be the September and October contracts, because these two contracts has the highest volume. You want to be trading a contract where it gives you great liquidity. You don't want to be trading a contract where you have low liquidity and there's an issue for you to always get out when the time comes. So importantly, always focus your attention to, if you are trading calendar spreads or time spreads, keep your focus. One is the near month contract, usually refers to third month active contract, and the second contract, the further contracts, always refer to the October or the subsequent month's contract. Don't do too far away, because once you do too far away, sometimes the volume is just not there. Now, this is what we call exchange calendar spread. Now, this is basically on Share Investor Station. This is basically a charting tool that charts the exchange traded spread. So here you can see, this is August-September contracts. You can see the volume per day is about 9,000. Obviously right now, August is considered the second month. The third active month is now September. So September, October right now is doing about easily 4,000 to 6,000 contracts per day. So that's quite liquid. So essentially, that's why the main focus is that when you want to choose which calendar month to trade, always look at the third month and the subsequent month itself. Don't do too far away, because if you can see here, if you look at, for example, December, January next year, December 2025, January 2026, you can see there's only 218 lots traded. Now, as you go further down into the contract months, as you go further, you can see that essentially almost some of the contracts are even not traded. So now, importantly, always look at volume as a determination on which contract months or time spread that you want to be trading off. Now, just want to address some common trading myths. Some says that spread trading is highly technical, so therefore it's very volatile. It's far from the truth. If in fact you look at it, if you compare September, October calendar spread with September outright today, it's a clear night and sky. You can clearly see that spread contracts move the high range of the day is only about 9 points. If you look at outright, you're talking about 150 points. Now, if you get it right outright, obviously it's a bonus. But if it's a wrong position or market go against you, you can get your risk exposure is actually quite extensive. So importantly, I think the myth that it's more volatile is untrue. In fact, if you do spread trading, a lot of people go into spread trading essentially just because it's a less volatile strategy as compared to just doing outright contracts. Now, it isn't easy to understand. This I do agree. Sometimes if you just tell people, look, you're doing spread, you're actually buying and selling one. Buying and selling particular contract or particular month simultaneously. The act of doing it simultaneously may not come easy. And essentially they try to put the emphasis on trying to trade on the relative value is also not easy. A lot of people just say, hey, look, buy low, sell high, that kind of concept is easier to understand. When it comes to relative value, it's slightly going to be different. But essentially, once you get the hang of it, again, the margins are small. So definitely it allows you opportunity to try to understand the concept by just doing one lot and see how it goes. So essentially, once you get it, it's actually quite easy, or in fact easier to understand as compared to outright contracts. Now, third myth I just want to address, and this is very important. A lot of people tell me that when you do spread trading, it's purely based on almost like betting where the market direction is far from the truth again. If you just look at exchange traded spread and some of your brokers platform, or even some of the charting platform, you can actually look at the charts itself and you can apply whatever technical analysis you do on the outright, you can actually apply that on spread. Now, keep in mind, because of the nature that spread doesn't move so volatile as compared to your outright, so sometimes the action per day might not be much. But if you just look at it, once the spread trends accordingly, whether it's a bullish trend or bearish trend, it actually appears quite nicely as compared to outright, where you get a lot of whipsaws, especially when markets are range. In the outright perspective, you get a lot of range. You get a lot of whipsaw signals. So technical analysis is actually very applicable whenever you look at spread trading. Now, fundamentals does not reflect age. I would say, if you are trading commodities has a pattern and the tendencies, seasonal tendencies, and therefore if you're doing calendar spread, is essentially a good thing, because there's always there's always a period where markets are strong, period where markets are weak, and usually we take those opportunities for us to build a spread position. Now, it has low volume. It's again far from the truth. I shown you in the previous slide. The third month on fourth month contracts, easy. You look at September, October contracts, calendar contracts are looking at easy, 4,000 to 6,000 contracts on a daily basis. So that's pretty much a high volume for you to participate. Again, keep in mind, always trade the third month calendar contract onwards. Don't do anything that's too far where volumes are very low. So this is what I meant. If you just look at this chart on the left, this S&P August outright. This is bottom panel is ATR, stands for Irish True Range. It measures the high and low of the particular period. Now this is daily. Now this on the right is the S&P August September 2025 calendar spread. Now notice this, the ATR for outright normally is on the daily basis is about 88 points. Now on the August September is only about 7 points. So essentially, you are trading a particular product which is much less volatile as compared to outright. Again, the principle that applies to understanding it might be slightly different, but when you look at technical per se, is still pretty much the same thing as doing an outright basis. So that's an important distinction that you have to take note of. Now, again, this is average daily volume. So normally the volume will start to build up once the contract becomes very active. For example, if the contract used to be the 6th contract, and as time progresses, it gets nearer and nearer, and it becomes the 3rd active contract month, that's where it starts to see volume start to surge. Now, daily volume, in excess, you're talking about if trading the 3rd active months, you're looking at easily, 4,000 to 6,000 contracts, which is quite huge, and the liquidity is there. So, if you're worried about volume, or like I say, always trade the 3rd month onwards. Don't do anything that's too far, where volumes are anything that's below 1,000 or even 500 lots per day. That's considered very illiquid. So those contracts you should avoid. Now, this is what I meant. Why is spread trading so trendy? Let's just look at here. This is basically your August September calendar spread. Notice this, when candles are start moving below the moving averages, you can see that the market this particular spread pair sentiments going to turn bearish. So in the sense that you're talking about the differential between August and September is going to narrow quite substantially. So true, in fact, I think it went to as high as 50 ringgit in difference, which means that August contract is priced 50 ringgit higher. Essentially, this spread starts to come down and almost close to zero. That means there's no price difference between August and September contract. Now, if you are looking at this particular chart, you'll be looking at, hey, look, it's a nice downtrend. Candles are below both the moving averages. You should be shorting this particular market instead of taking along. So you can apply technical analysis like moving averages to further your technical analysis on the chart on the spread trading markets. Now, I also just want to put out and highlight to you this. So if you just look at one of the table I showed to you, all the different, I think there's a total of 24 contract months, future contract months that's listed for the FCPO market. So you have contract right until the year 2028. Now, obviously, no one knows what will happen 2 years later. So a lot of people just want to focus at least for the first 1 year. So looking at, right now from June 2025 to June 2026. So if you plot all these different contract month prices accordingly, there's a pattern that you can see. And importantly, when you start to notice that when the near month contracts are trading much higher compared to the further month contracts. Now, this was the rate one was taken back in early April. You can see that really the June, July, August contract, they're trading much higher prices. You're looking at 4,005. While you look at September contracts at that time, they're trading about 4,003, 4,002. Now, in this type of market, this is what we call backwardation market, where the front contracts are very strong. Front refers to the near month contracts. They are very strong in terms of price. Now, the far month contracts or the further month contracts are trading much lower prices. Now, this is what we call backwardation. In a backwardation market, people always think that, future market is going to be very bearish. Now, in one sense, it's true, but importantly, the message of the market try to paint is that the current market or the current near month contracts is just way too tight. That's why people are willing to pay higher prices, and they push the June, July, August contract to much higher prices compared to September, October, because they believe that because the current supply is tight, once the supply starts to ease going forward in the next couple of months, price will have to come down. That's why it's called a backwardation market. Now, curve doesn't always stay like this. Sometimes it can become where you just look at this happens in pretty much 20th of June, I think just last week. You have a different scenario now. Now you have a situation where June contracts now trades at 3,008. Now, if you just look at where September, October is, they are much higher compared to June. Now, this is a weird scenario. So you're telling me, 2 months back, June contract was the best, was the highest contract. Now, in fact, June contract, I think just last week, it performs the weakest. Now, dynamics of the market can change and sentiments of the market does change. And this usually relates to fundamentals. Now, in this, when fund contracts are much lower or further month contracts are performing much better, this is what we call a contango market. These are all very technical terms, but what this is essentially telling you is that you're comparing near month contract prices and further month contract prices. Now, why this sentiment change is important, and I wish to highlight, is that, when markets are so bullish, when people are expecting that, supply is tight, we are probably looking at stocks level coming down, usually fund month prices, are very strong. Now, when people start to expect, look, supply is coming back, demand is weak, war is happening, there's uncertainty, people don't want the demand. So demand starts to come down, supply starts coming back. You start to see front prices like June prices starts coming down massively. And when that happens, normally it tells you sentiments have changed. Now, why understanding this type of curve gives you information? Because by understanding how the curve moves, it gives you sort of like where the market is behaving. Are we in a situation where the market is too bullish, or are we in a situation where market is actually quite bearish? So in fact, if you just look at how the curve has transformed, in early April, the market was actually very bullish in the sense that, everyone is telling, we're going to be short supply, stocks is coming down, Malaysia is definitely going to have, CPO stocks problem. But that changed back, I think, in early or late May, when MPOB starts reporting there's excess supply, stock levels are climbing to above 2 million. So you can see how sentiment has changed quite drastically. Now, why this is important? Because by looking at this, you can form some spread dynamics. So if you notice, if you start looking at a trend in particular, like let's say June, July spread at that time, you notice that actually the trend has been coming down, indicating to you that, supply is coming back. This June, July calendar spread is going to get narrow substantially. And now, in fact, if you just look at where the spread is, it's showing negative spread. So negative spread is something bad. Is this telling you, if you just look at if September, October is a negative spread, that means September prices is much lower than October prices. Now, in this market, it's just telling you that it's definitely oversupply, is a bearish market. So understanding this outright dynamics gives you indication to how you see your spread, and importantly, how you see the sentiment of the market behaves. Now, this is just plotting the different calendar, or we call it time spread months. So you have a July, August, Sep. If you just plot it across time, again, you can see now, back in early April of this year, the July-August calendar spread was trading about 50 points premium, which means that July contract was priced 50 ringgit more expensive than August contract. Now, if you notice, the thing has quickly changed. You look at where we are back in, I think, late May or early June, it has almost come to zero. So this tells you, when you have such a huge premium, and when market forces are telling you that, hey, look, supply is coming back, fundamentals are getting more bearish, a lot of these spreads from high premium, it turns to either into a par, or in fact, some may even go to negative. So it's a good condition. If you just follow fundamentals, that will give a good indication for you to, whenever you see a positive premium or high premium prices on certain calendar spread, and you know yourself you're entering to a weaker period in terms of prices for CPO, that will be a good time for you to actually be quite bearish on certain calendar spread. So that's how you look at the dynamics of looking at fundamentals and applying that into the calendar spread dynamics of the CPO market. Now, why I think it's important for us to look at fundamentals when it comes to trading spread is because, like I mentioned earlier, there's always season or period, or there's period in time where markets are performing much better, and there's always period of time when markets are not so well. So you can see here, this production period from January to December, this is based on MPOB. You can see right until early April, the start of early April, production starts to rise. And usually it will continue right until probably late October or early November when production starts to decrease. So if you are looking at prices, you probably will notice that June, July, that's where we are right now, it's going to be a period of weak prices because production is actually very high. But when it comes to November or December, that's where you need to be a bit more careful, because you can't be too bearish on price, because that's where production tends to decrease. Now, I'm not saying that this year is going to follow the same pattern. There's always a period of year where it doesn't follow. But throughout the whole past decades or 2 decades or so, you can see that the production pattern is actually very clear. Now, however, weather can take a toll. Sometimes the weather can disrupt the production pattern, but it's safely to say, based on historical trend, we can roughly gauge that, as we head into September, October period, that's where you need to be more, you can't be too bearish on prices, because that's where you're entering to a low production period in the CPO trend. Now, because of production pattern like this, you can clearly see that also, if you just look at the build-up in production after March, April, stock levels are also start to build. And importantly, you look at where build-up tends to stop, is usually be around November, December. So again, it tells you it follows quite in line in how your production patterns perform. So once you have rising production, you can safely expect, you should also see higher stock levels in coming months. Now, this is just basically definition of bull spread and bear spread. Now, bull spread is basically, you are looking at buying near-month contracts and selling far-month contracts. Now, this usually happens when you are quite bullish, in terms of the near-month contracts. Now, these markets usually behave that, for example, if you notice that, near-month supply is getting tight, demand is very strong, the prices are going up. And usually you should see also the spread starts to go even higher. So in this kind of condition, when you expect that, the near-month contracts is going to be more bullish than the further-month contracts, you should be buying a spread. So in this technical example, we call it bull spread market. So one example is that you can long a March, in this case, a September 2025 contract, and you can short October 2025 contract if you're believing that the market is going to be bullish going forward. Now, vice versa, if you believe that the current market is probably oversupply, oil is coming down, which is closely related to palm oil, all these negative forces is coming in, you should see near-month contract prices should come down come down faster compared to the further month contracts. Now, in this case, you should be shorting a spread, hoping that the near-month contracts will move in a downward manner, much gradual or much bigger momentum compared to the further month contracts. So this is what we call bear spread market. So usually what you do is that we usually short, in this case, let's say short September contract and long December 2025 contract. So that's how essentially we term the bull spread and bear spread market accordingly. Now, so if you just look at it, the movement between outright and calendar spreads are actually quite coincide together. So every time when you see strong outright movement, you also could expect the same similar movement in the calendar spread as well. So for example, here the red one is showing you the FCPO August outright contract. If you compare that with your August-September calendar spread, you can see that whenever August starts to rise in tandem, then you can see you most likely to see that your spread contracts will also rise in tandem. So example, when August contract starts to decrease, you also could see the calendars, August-September calendar spread will also start to decrease. So the outright movement and the calendar spread movements are quite similar. Now, there's obviously occasion and time or instances where both markets are moving in inverse or in a different manner. So you have outright contracts moving up, but sometimes your calendar spread doesn't move up. In fact, it does comes down. So there's occasion like this. So you can't really use outright contract as a gauge to really see the direction of where the calendar spread is going to head. So it's importantly to also look at other parameters, and especially when you look at technical parameters when it comes to calendar spread contract itself. Okay, now not to say that because I mentioned earlier, spread is less volatile, it's only moving about 8 points a day. That's very small volatility. Now it does happen. When spread does go berserk. In fact, during the time when spread goes berserk, normally it does indicate to you potentially there's a crisis happening. Now, just to draw an example, this is basically back in 2022. You have the July-August contract. You can see that the contract was trading prior to the Ukraine-Russia conflict. The spread was trading about 80 to 100 ringgit premium. But then, because of the conflict that actually escalated in the Ukraine-Russia, that created a lot of uncertainty when it comes to vegetable oil market. You can see how there's a sharp movement in rapeseed and whatnot. Other related vegetable oil, palm oil also follows suit. So from the spread from 100 to 150 range, it went up to as high as 350 to 400. So it does go into a very volatile fashion. Not to say that the range of a particular market is going to be very small. It can be a huge movement when it comes to spread. So keep that in mind. But nevertheless, if you recall back in those days during the peak of the Ukraine-Russia conflict, CPO broke an all-time high record about close to 8,000 ringgit per ton. So the outright movement is also much greater fashion as compared to spread. But however, you must acknowledge that when times of crisis or uncertainty, major uncertainty, you do see sometimes the spread can actually go into a very volatile range as well. So do keep that in mind. But in normal times, in normal circumstances, spread range are actually very limited, and in a sense that it's actually limited your risk exposure. Now, just looking at CPO, palm oil, and bean oil, so you can clearly see that there's quite a close relationship between these two. Now, obviously, there's a period of time where both of these markets can diverge, and usually it's always a term that bean oil should trade at a premium compared to palm oil because the cost of producing bean oil normally termed as higher. Now, whether that's true or not is usually back for debate. But what I want to highlight is that there's always a period of time where, if you just look at this chart, this is looking at the price differential between palm oil and bean oil. Now, we just look at this orange line is a zero line. It's just telling you that the bean oil and palm oil is actually on par. But there's always a period of time where these two particular commodities actually trade at a discount, which means that palm oil is actually more expensive than bean oil. Now, notice this over the past, let's say a couple of years or almost close to 10 years, you normally notice that every time when bean oil goes into a discount, that discount wouldn't last for a long period. Now, as compared to a premium market where bean oil trades at a premium compared to palm, it can last for a very long time. Now, in fact, I think normally when at this point in time during the height of the Ukraine crisis, we have seen this particular spread went to as high as $800, which is very massive. We have not seen that. It tells you that means that the palm oil is way undervalued. And true enough, I think given a couple of months later, palm oil did a catch up and reached to 8,000 ringgit. So what this is telling you is that, if you're doing this spread, always take note that spread can stay quite elevated. It can stay a particular range for a long period. So it doesn't mean that, the long-term average for a particular spread pair between bean oil and palm oil usually range about 100 to 150. Now, it doesn't mean the case that, once you reach 800, it should go back to 150. Mean reverting strategy does work in certain ways, but it is all matter of period of time. For this $800 to went down to 150, it takes about 2.5 years. So it's a long period. So if you're holding to a position, it could be very tricky once the market spread stays quite elevated for a very long time. Now, I'm not going to go too much on soybean oil, but you must, if you are trading the palm oil market, you are looking at intermarket commodity. Bean oil is one perfect commodity to look at in relation to palm oil. But bean oil fundamentals and palm oil fundamentals are completely different. Although their price movements are very similar, but bean oil is definitely much affected by different variables. And I think right now, what is really lifting market sentiment in the bean oil market is the biofuel segment. So that's another view to look at. But if you're looking at spread, essentially you're just looking at the differential between bean oil and palm oil and how big of a discount and premium are they doing. Now, these are factors affecting palm oil prices. So I've covered a few of them. Now, supply and demand dynamics are very important. You can't run away. So if you are trading palm oil, S&D is very important. You have a market that's oversupply. Normally, palm oil prices can't go up too much. If you are under supply market, you should see prices going up. Now, ringgit is an important element. Weather, government policies, these are all quite essential. But then again, these are all quite unpredictable. Supply and demand, in a sense that based on seasonal pattern, you can roughly gauge. But the other factors, you can't really do that because that's pretty much uncertain factors that can actually disrupt market forces. So just look at this. If you just look at CPO price with production, it's very clear. Rising production normally means lower prices. Lower production means higher prices. So supply and demand still triumph as a major factor when it comes to CPO prices. Now, this is stock levels. So if you just look at the spread I shown you earlier, July or August, September calendar spread, they're doing positive. They're doing 50 ringgits premium. But all of a sudden, when it comes to late May or early June, you start to see this spread starts to collapse and went to zero or even negative. It just tells you one thing. It points to you that supply in the immediate future or the current supply is going to go up and the stock levels are going to go higher. So that's bearish for the market. So this is where we are. We are almost reaching the 2 million tons. So once it goes above that, pretty much it's actually quite bearish for the market. Now, I don't go too much on this. This is just telling you that stock prices is pretty much the same as stock and prices are actually very inverse. So you have high stock levels. It tells you that the market is going to come down or it's going to be pressured. You have low stock levels. Normally, that's a good thing for prices. Now, how low is low? The 2 million is a critical mark. Anything that's below 2 million, that is telling you market is tight. Now, once it goes above the 2 million mark, it's telling you the market is pretty much oversupply. So crucially, why the calendar spread for this particular period, especially for the past couple of days, has actually been quite negative is because people are anticipating that supply is coming back and then the stock levels is continuing to rise. If this is the trend that's going to stay for the next 2 or 3 months, you should expect spread to stay quite bearish in certain ways. Now, this is export. Now, you look at production, it's quite clear. Now, when it comes to export, not so clear. There's always, I think, middle of the season, there's particular month where it's strong, especially June, July. But I think one thing to clear, because India and China are very big buyers. So once you approach towards the later part of the season, you notice that, usually there's a slight uptick in prices. That usually means that, or demand for palm oil, that usually be before the Deepawali season. So that's another trend you can look at when it comes to export. But other than that, you can't really see a proper or clear pattern as compared to just looking at production or stock levels. Now, India and China, if you're looking at demand perspective, these two are the biggest buyer for Malaysia palm. So obviously, if the economy is doing well, you should see palm oil prices strong because the demand is going to be robust. But if now people are looking at recession coming in, that usually will impact palm oil. So when you're looking at further month contracts in terms of spread contracts, you have to be careful. If the outlook for next couple of months is not looking good, don't expect those spread prices will do well as well, because if essentially the fundamentals will also kick in as we go towards the next couple of months. Now, ringgit, I think it's fair to say when you have a weaker ringgit, normally is a good thing for CPO, because a lot of importers, when ringgit is weak, it means cheaper prices to buy. When you have a stronger ringgit, normally that's not a good thing, because that means CPO is actually more expensive. So keep in mind, I think weaker ringgit is always beneficial for palm oil, but you have a stronger ringgit, that's not necessarily good for CPO. Now, crude oil and palm oil, actually they move quite in line, obviously because of the biofuel element. So you notice last couple of weeks, palm oil prices actually very strong because of the tension in Middle East. But as of today, you can see that the collapse in crude oil really also put pressure on the palm oil prices. Now, the funny thing is that, you see outright prices move at least 150 ticks for today. But when you look at September or October calendar spread, the movement is only about 8 ticks or 9 ticks. So, in time like this, on time of uncertainty, if you are doing spread trading, in a way, is a better risk management as compared if you are doing outright. You gain the whole risk exposure. You never know what Trump will do. He can just call the deal off. He can, or the tension can get escalated quite quickly. If you're in outright position, you gain you are exposed to the whole risk quite substantially. So that's important distinction you must make whenever you're doing outright and spread. Okay, I'm not going to go too much on weather. Weathers are looking normal. I'm not a weather expert, but whenever weather kicks in, extremities kicks in, the first thing you must always look at, price will move, and importantly, how the price curve will move. So it's essential that we have to see this weather factor quite prominently in certain ways. Now, I'm not going to go too much of weather extremities, but the key thing is that if there's El Nino weather phenomenon happens, if it's a confirmed El Nino weather, normally you expect prices to jump quite rapidly. Now, if that's not the case, then you should see prices tend to hover around certain period. But when weather extremities starts to confirm, normally you start to see strong prices going forward. Now, you just look at seasonality of palm oil few years over the past couple of years. One thing to take note of is that if you notice, palm oil prices has actually been holding very well above the 3,500 mark. Now, keep in mind, if you look at the historical perspective of where palm oil prices is over the past 2 or 3 decades, you can see that over the decades, over the past 10 years, every 10 years it shows a progression upwards in terms of where prices has been trading. So it tells you that in certain ways, the cost of producing palm oil is no longer cheap, and it goes higher and higher year-on-year basis. So that's essentially also be a good point that if outright prices it tend to be go to a certain floor level and doesn't break that, because once it breaks the cost of production, normally there's no incentive for producers to keep producing palm oil. Now, this is looking at price seasonality, so it's very clear that you have strong price performance towards the year end, and you have very weak performance towards the middle of the year. So right now we are in June, July. So normally I expect prices to close the month quite bearish mode because of the seasonality in play. Now, this can change. It's not to say that this is a tool that we must is 100% thing, because there's always seasonal tendencies are not always happen in certain instances. So there's always period where it doesn't follow. So keep that in mind. But based on historical perspective, we are in a period where prices are a bit soft, because if you just look at where production is, we are in rising production period. When you have rising production period, normally you should expect prices tend to be weaker instead of stronger. So that's pretty much on fundamentals on how to relate into spread trading. Now, looking at it, the next big thing is that looking at technicals per se. So really, I think if you look at CPO spread, you can actually apply certain trend trading strategy. Now, there's many ways to look at trend in a particular market. You can look at it visually. You can obviously put a moving averages to depict where the trend of the market moves. And one of the key things if you're looking at trends, one of the candles that you can use is to look at Heiken Ashi, which I'm going to share with you later part. And if you pair that with moving averages, you actually get quite a good entry signals and exit accordingly. Now, in every trading plan, you must have a way to manage your way out. And one of the ways is just to use average true range. We're going to share later a bit on how to do that. So this is looking at SCPO August-September calendar spread. So you can clearly see that at this point in time, the market was actually doing very well. Back in early of the year, this calendar spread was actually doing quite positively. It's telling you that August is priced higher compared to September. Now that has changed pretty much into late April or early May, when it goes from positive 50 down to 0. Pretty much there's no price difference between August and September, because if you recall, production starts to pick up, supply is coming back, that's where pressure starts coming in. And the moment you start to see this type of candles trading below the moving averages line, it's just telling you that this market is poised to go lower. Same goes for here. As long as the candles are still trading below, the moving averages are pointing downwards, it's just telling you that this spread market is actually heading downside instead of further upside. Now, this is SCPO September, October calendar spread contract. You can look at it. It's quite, in a way, quite range. We started off the year quite badly. It went from positive 40 as a premium market. It went down to par, almost 0. Then there's a slight momentum, but then it goes sideways. Right now, it's still pretty much on a sideways market, but it's important to watch where the market may hit in the next couple of days or weeks. Now, this is October and November calendar spread. Again, you can see very similar pattern, because September, October is sideways. Very likely the October-November calendar spread also show you similar pattern as well. Now, look at the volume. The daily volume is slightly on the lower end, because at that point in time when this data was captured, they are not an active contract. If you compare that to September, October, the daily traded volume is about 3,000 to 4,000. So it's much higher compared to October, November. So if you are looking at a particular spread pair to trade, always judge by the volume. Once you have a higher volume, it gives you, in a way, it does indicate to you there's higher liquidity in place, so that you are able to get out of the market in case you need to. Now, which chart is better for trend trading? Chart A and chart B. Now, this is the same calendar contract month, same period. The only difference is the type of candles used. Now, chart A is what we call your normal Japanese candlesticks. Chart B is your Heiken Ashi. Now, if you're a trend trader, obviously you look at chart B, because chart A gives you a lot of mixed signals. Sometimes the candles are red, sometimes the candles are green. You're not sure whether the market is trending up or down. Now, in chart B, when you use Heiken Ashi, as long as the candles are green, it's just telling you the market is going up. Candles are red, showing you the market is coming down. So 3 distinct patterns only. You just need to understand whether the color of candles is green or red. Now, if you start to notice, like in a red bar, there's an upper and lower wick, usually tells you that the momentum, the downward momentum is losing strength. Same goes for a green candle. Now, the candles that you need to watch are these type of candles, where if it's a green candle with only upper wick, it means there's a strong bullish trend. If it's a red candle with only a lower wick, it's telling you that this is a strong downward trend. So these are the candles in the trend that you need to observe. Now, when you start to see like almost like small body, long doji style candles, where small bodies, almost like a doji style, you should be careful, because this is telling you that the market is exhausted. So the particular trend at that time in the market is probably, there's not much strength left. So if you are holding to a position, you should be out of the market by that time. So difference between Heiken Ashi and Japanese candlesticks. Again, I think Heiken Ashi is widely used for trend trading is because it's easy to identify. There's only 3 distinct patterns. You don't need to look at 100 over combination. There's only 3 different patterns you need to take note. Now, if you are doing algo or you're doing some sort of automated trading, you can actually code the formula of Heiken Ashi as part of your coding decisions. Now, Heiken Ashi, because of the nature that it shows you the candle, the trend of the candle. So in that sense, it's showing you trend of the market. Japanese candlesticks are more reversal. So every time you try to identify combinations, talking about reversal of the market. So Heiken Ashi is based on color. Japanese candlesticks is actually more based on pattern. So just to show you the dynamics, so here we have a series of red candles. So as long as this series of red candles are below the moving averages and trading below, moving averages can also use as a crossover. You have what we call bearish crossover, where the shorter moving average crosses below, and the candles are below both the moving averages. This is telling you this market is poised on a downtrend. So you can see that how trendy it is. The market can continue to trend for, I think this is almost close to a month. So it went from as high as positive 70 premium. It went to as low as 0 back on par. So again, it's just telling you when you have premium spread market going into 0, it's just telling you that market fundamentals are shift. Probably the market is moving to more slightly bearish undertone. Therefore, that explains why the spread market actually has narrowed substantially. So at this point, you can actually short a particular spread pair and hold it until you reach your profit target level. Okay, and be careful once you start appearance of green candles like this, especially after a series of downtrend. When you start to see strong body green candles, it's just telling you that this downtrend that you're holding is probably going to be a change of trend. So that's why you need to be careful. So again, here you can see, if you see a series of green and red together, it's just telling the market is moving sideways. This is where it gets interesting. Once you start to see long series of body of green candles, usually it tells you the market is poised on uptrend. Vice versa, you start to see a long series of red candles, just telling you that this market is poised on the downtrend. Now, if you just use Heiken Average, it may not be sufficient. So therefore, you got to pair with moving averages. Now, there's many types of moving averages. I think the main focus that I want to highlight today is just to look at the exponential moving average. Now, the calculation for exponential, why is it more widely used, is because moving averages itself is a lagging technical indicator. So in the sense that only when prices move, then only it reflects. So exponential, in a way, it puts more weight to your recent data. So therefore, it actually moves quite rapidly when the price change accordingly. So that's why a lot of people use exponential type of moving average as compared to simple moving average. So what we have here, you look at this, the red one moves quite closely to the price. If compared to the green one, which is your simple moving average, it should move quite less. So it's very clear, if you want to use, type of moving average, the exponential one is the one that's moved quite fast with the moving of the price. Now, moving average are mainly typically used for crossover. So you have 2 different varying periods or 3 different varying periods in certain sections. So crossovers, the moment when shortest of the periods start to cross, the longer term periods, that's where usually you get what we call crossover signals. And the moment when candle starts to trade above or lower than the moving averages line, that's also a good indication that the market is poised to go to a certain direction. So you can see here, this is pretty much a bearish crossover, but then again, the candle starts to go above. So from that here on, you start to see there's a bullish crossover in terms of your moving averages. So that's how you use moving average to gauge, the buying and selling of a particular spread. So same goes for here. This bearish crossover, the moment where you start to see red candles starts, penetrating the lines below, then you start to see there's a bearish crossover. Vice versa, when you start to see candles breaking above the moving averages, you can start to see that basically the candles are moving quite high rapidly. Now, I just want to introduce another trend too. It's called Directional Moving Index Indicator, or DMI for short. Now, in DMI, there's 3 particular lines. I'm not going to go too detailed on this because obviously you can go and Google, or you can ask ChatGPT on the derivation of this particular trend tool. But what I want to highlight is that, in DMI, because there's 3 different lines, the blue one is what we call positive DI, the red one is called a negative DI. Normally, a blue one measures positive momentum. So whenever prices goes higher, this blue line goes even higher. Whenever the market starts to go downtrend, you start to see the red or minus DI starts to go higher. So the blue line measures the strength in the bullish momentum. The red one measures the bearish momentum. So whenever you have crossover signals, like for example here, you have the positive DI crosses above the negative DI, just telling you that this market is poised to be a bullish market, because once you see that, as long as the bullish cross above and it stays that way, you can see that this momentum actually goes higher. Now, vice versa, when you start to see a negative DI, the red one crosses above, that's where you start to see that now probably the market is going to hit lower because the bearish momentum is gaining strength. But if you correlate your moving average crossovers, they're actually quite similar in terms of signals generation. So, you can either use moving average crossover or you can even use the DMI crossover as part of your strategy. But either one, you just have to choose one because both of them are giving you very similar signals. But what's important in that DMI is the third line, is the ADX. Now, ADX is actually based on a value. It's part of the DMI indicator. So what this ADX measures is the strength of the trend. So once you identify where the trend is going, whether it's uptrend or downtrend, doesn't really matter, but you need the ADX value to stay above 25. If it does, it's telling you that this particular trend is strong. Now, the moment when ADX starts to fall, it's just telling you that this particular trend is exhausted. So if you're holding to a position, you should get out, because when the trend is in place, when it gets exhausted, if ADX is flat, it's no longer rising, that's where you need to be careful. So if you're holding on to a position, you should be out from the position itself. ADX is based on a value. Anything that is above 25 is just telling you that the trend is actually gaining momentum. Now, anything that's below 20 or below 25, it's just telling you that market is heading sideways. So in a sideways market, you try to do trend trading strategy, it may not work. So keep that in mind. I think ADX is a very good measurement as part of DMI tool for you to measure and gauge the strength of a particular trend. So how will you apply here? You can see here, you can see this black line is your ADX. So once ADX starts to rise, it's just telling you that this uptrend is actually very strong. Now, notice the peak here. Once the peak is reached and start coming, when the ADX black line starts coming down, it's just telling you that this uptrend is exhausted. In fact, potentially it can signal to you there's a change in trend. So if you're holding on to this long-term, long position, you should be out of the market. Vice versa, if you see a downtrend like this, very strong bar, and the ADX is rising, it's just telling you that this downward momentum is actually very strong. Now, once ADX starts to become flat, usually markets hits into sideways. So it's just telling you that once ADX starts to go flat, you are holding on to a downtrend position or a short position, you should be careful and should be getting out of your position once the strength, the downward strength is actually losing its momentum. So last bit, judging from where, importantly, to look at where the direction of the market behaves, the next best is to gauge, is to put a particular profit target and your stop loss accordingly. Now, one of the ways is look at ATR. So what I have here is that you just look at the FCPO calendar spread here. The ATR value ranges from between 11 to 4. This is on the daily basis. So the range of a particular spread is actually very limited. And especially if the outright markets are getting or moving into a sideways range, the spread can be actually very minimal movement as well. So keep in mind, the volatility nature of a calendar spread contract is actually very limited. As you can see by the ATR value here. But there's obviously certain instances where it can become volatile. ATR can actually rise quite rapidly, which does indicate to you that the volatility of the market is actually increasing. So you can see here the SCPO outright contracts. Normally the range is easily from 80 to about 100 or 150. So that range is very quite wide. So if you compare to spread trading, is much lesser of a volatile product for calendar spread. Now, I just want to apply all these three together. So what you have here is that you have Heiken Ashi, and once you have Heiken Ashi bars pointing to you that there's a strong green body bar, and all these candles are well supported above the moving average. So it doesn't break the below the moving average. So it points to you that this uptrend is still quite intact. Now notice this ADX is rising. Once ADX goes above 25, usually that's a sign that this particular market is rising. Now keep in mind the ATR at that point in time or that particular period is 3 points. Now is a very low volatile product, so that's something that you have to take note of. So one way is to set up your profit target and stop loss levels accordingly is to use the ATR value. So if you look at risk to reward ratio of 1 to 2, you are looking at 6 points of profit and 1.1 ATR or 3 points of loss. So that's how you manage your risk accordingly. Now this particular spread was doing about 41, so you probably can enter at this, but hopefully that this premium market is going to sustain. and eventually this market is going to hit, or this spread market is going to hit higher. Now, another example, this is where you start to see there's bearish undertone for the spread market, and you start to see ADX is rising, and the red Heiken Ashi bars is actually below both the moving averages. So it's actually poised to you to tell you that this downtrend market is just starting with strength. And normally when ATR value starts to rise, it's also a good indication to you that the market is actually gaining momentum. So there's trend pretty much happening in place. So there's a couple of ways. So ATR doesn't only tells you the range, but also gives you an indication as to when the market becomes more volatile. So same goes, ATR is mainly used for your profit target and stop loss level accordingly. So ATR value at that point in time is about 3 points. So you're looking at 6 points as profit, 3 points as your stop loss. So these are examples, classic examples of bearish spread, because you just look at it, we have been holding well above a premium market, and eventually once forming of a red Heiken Ashi candles like this in a spread market normally dictates to you that this market is going, or this spread market is going to enter into a bearish market mode, or rather this premium is not going to last. This is actually a premium, so it's a positive 9 on the spread. Eventually I think it went to par and it went to negative territory. So once you start to see this type of pattern starts to form, it's just telling you that the market is actually quite bearish for the spread market. Okay, now this is what happens in the next couple of bars. There's obviously a lot of contention, a lot of ways. Some may say that I think if you just follow your ATR setup, 6 points, you'll probably be out here, but the market went even lower. Now there's many ways to it, but a plan is a plan. If a plan that you have established to get you out based on the ATR, if the ATR has targets as hit, that's the best place you should be out. Obviously you can hold until ADX starts to peak. That's a whole different matter, but a plan is a plan. You should stick to your plan. Then opportunity in the market will always be there as well. So this is where September, October calendar spread is. I think it broke below 0 as of last couple of days. So if you are looking at September, October spread, crucially you need to understand that if it can hold above 0, it's just telling you that if it doesn't break above 0, this spread can continue to be on a downward momentum. That means September contract seems to be more negatively priced or lower priced compared to October. For the simple reasons I mentioned earlier, fundamentals are just not strong enough for a bullish market to persist. Now, obviously, you have all this trade tension, Middle East conflict that may, in a way, support the spread to be more positively. But as of now, if you just look at where technical indicators or charting is, it's just telling you that this spread is likely going to hold below the 0 mark. So last bit, once fundamentals are in play, once technicals are used to deploy, last but not least, if you're doing, as a trader, if you are new to the market, every decision that you make, you usually have a way to look at or review your trades accordingly, because we need that. Especially in our firm, when we have new traders joining us, we always encourage traders to always record or review their performance accordingly, because that's you need data to support whether certain strategies are giving you profitable decisions or not. Okay, I think I'm just gonna end with this quote. I think it's important. What I mentioned earlier, if you are new to spread trading, really I think it's very similar to outright trading as well. In fact, the benefits of spread trading is actually quite immense. But however, trading, whether it's spread or outright, still requires a lot of patience. And the key thing is consistency and discipline. So I just want to end here with just a quote from Alexander Elder. The goal of a successful trader is always to make the best trades. So I want to emphasize this, it's not really about money at the end of the day, it's really about processes. So if you're doing this full-time, you're doing trading for full-time basis, always emphasize on the process rather than the outcome. So I'm just going to end here. I'm just going to pass it over to CY for any questions from the audience.
All right, thank you very much, David, for your informative. has gained lots of valuable knowledge and insights about spread trading. And before we enter into our Q&A session, if you guys have any questions related to David's presentation, please type your questions in Slido so that I can capture them and address them easily. While waiting for questions to come in, I would like to ask a small favor from all of you. Please take a quick minute to fill out this feedback form since we have provided an informative session for today. It will take you just only less than a minute to complete this feedback form. You can use your smartphone to scan this QR code or click on the link in the chat box so you can fill up this form. Your feedback is incredibly important to us as it helps us improve our future sessions and ensure we continue to deliver high quality content tailored to your learning needs. So please take a quick minute to complete the form and we will begin with the Q&A shortly. Another 30 seconds to go. All right, a minute has passed. If you have already submitted your feedback, thank you very much. And if you are still completing it, feel free to continue. Now let's move on to the Q&A session. Now, David, here are a few questions for you. The first question, given that there are so many different types of spread contract, so how do we actually choose which spread months to trade?
Okay, that's a good question. So I did mention earlier in the beginning of my slide presentation. So you have always choose the contract that has highest volume. So usually the highest volume would be the third month contract. In this case, it's a September 2025 contract. Now you can pair September with obviously the next coming month, which is October. So September, October 2025 calendar spread is usually the most active traded calendar contract in terms of volume. So use that as a gauge, use the volume as a gauge. And when you're doing calendar spread, normally you have to involve the third month contract because of the liquidity of the contract itself. Now, obviously, you can pair with other months as well. You can do a September 2025 with a December 2025 or September 2025 with a January 2026. You can do that. But keep in mind, when you take contracts as far out, normally the volumes are much lesser. And you run a risk where, sometimes the slippages because of the bid and ask is wide and whatnot. So always trade with the highest volume. Pick the calendar contract months which is the highest volume, and trade based on that.
All right. Another question this participant asks is that if we were to short one spread contract in one account and then long another spread contract in another different account, but the contract month is actually the same month, does this consider as a spread or not?
Okay. Now, in that sense, it doesn't because it's not on the same account. But I mean, technically, is what you're doing is still essentially a spread, but it's on a different account basis. In technical sense, it does. But why do that when you can actually use a exchange traded calendar spread? You can definitely do outright. Manually enter outright contracts to represent a spread, but then again you have exchange traded spread, which makes your job easier.
All right, another question, whether spread trading is more suitable for a casual trader or a full-time trader?
Okay, I would say this. I think trading in general, if you want to do this on a full, I mean, you just look at trading statistics. So just to answer the question, you just look at trading statistics. Full-time trading is always required. You can see the success rate is much better when you do it full-time. But obviously, there's a lot of decision that you can't. Why certain individuals can't do it on a full-time basis. Now, to answer that question, whether spread is more suitable for full-time or part-time basis, I would say this, is in certain ways it's also very similar. It requires a similar attention as to how you do on an outright basis. So although sometimes spreads doesn't move that well or that volatile, but it also does require you to monitor it quite constant basis. So I would prefer that, if you're doing spread trading, full-time doing it is a much better proposition as compared to doing it on a part-time basis.
All right. While we are still in this question, we have other similar question as this. For example, whether is spread trading suitable for day trading or position swing trading?
Okay, that's a very good question. Now, if you just look at, if you can, I would say because the volatility nature of a spread trading is much lower. So therefore, you can anticipate a bigger buffer as compared to doing outright. So you can also apply swing strategy. So in that sense, because the volatile nature of spread usually is much lesser, so you just want to be just taking a couple of points. You want it, if the spread markets really trend, you want to be capturing pretty much a big percentage of the particular trend. So swing strategy may work in certain ways. Now, but because of my role as a proprietary trader in our organization, we don't encourage our traders to hold position that's overnight. So because of that role, we have, whenever we do spread trading strategies, usually be on a day trading basis. Now, it does also applies if you can use swing trading strategy to hold on spread, because of the volatility nature of a spread is much lesser. So in that sense, you can actually keep to your positions for a bit more time as compared to just closing things on an intraday basis. So hopefully that answers the question.
Okay, we are going to pick a couple more questions before we end the session. Now, which fundamental factors have the most significant impact towards spreads?
Okay, I would say this: supply and demand, S&D, you can't run away. So I've shown you a couple of instances where we started if you recall back in early April, some of the spreads were doing premium, whereby the near month contracts are priced at much higher prices compared to further month contracts. But now you just look at where spread positions are. There are some of them, the near month contracts are priced lower, or we call it a negative spread or bear spread. So this relates to fundamental, because why is that the case? Because supplies is coming back. We are now in a rising supply situation based on a seasonal pattern, and stock levels are rising. So you supply and demand dynamics does affect the spread dynamics as well. But having said that, it's not only constrained to supply and demand. There's obviously other factors that's being involved. For example, like geopolitical tension, that's what we're seeing right now, or oil spike or whichever, can also disrupt the spread dynamics. So these are a few key things. But I think supply and demand is a good way to really look at how it affects the palm oil spread dynamics.
All right. There is another question. Given that spread trading, the chart might looks a little bit different from outright, whether does the common technical analysis rules and trading strategies still applicable using spread charts?
That's a very good question. If you look at it, the parameters are slightly different. You can't be using, let's say on outright, you look at Heiken. Heiken actually you can apply in both instances. The only thing is that the period could be different. Now, spread doesn't move so volatile. So in that sense, you can't be doing like 30 minutes time frame or 15 minutes time frame, because the spread doesn't move that much. So in the sense that you got to use an extended or longer time frame if you do as compared to doing an outright trading. So spread normally you can look at an hour or 4 hours or even a daily basis as a way to make your decisions. Then other than that, other parameters is that moving averages, you probably can use a longer time moving averages, because the nature of the spread doesn't move as much as compared to outright. So these are some of the parameters that you maybe need to tweak whenever you are looking at spread and whenever you are looking at outright. But the principles are the same. If you are trend trading, look for ways to identify the market trends, which is Heiken Ashi, moving averages. Then make sure whether the trend is still strong, judging from the ADX value. and always measure your profit target and the stop loss level accordingly based on your ATR value. So the principles remains the same, but again, the parameters may tweak it in whenever you're trading the spread market.
All right, we are going to pick one more last question. What would be the best or suggested risk and reward ratio setup for spread trading?
Okay, risk and reward is very individual. Some people prefer, if you are someone that wants to trade more often, more frequently, normally you can do 1 to less than 2 as a reward, maybe 1 to 1.6 or 1.7. Usually there's a metric that's used accordingly. Now, if you are someone that looking at swing, and because the nature of spread itself is not so volatile, then you should aim for higher reward ratio, maybe 1 to 3, 1 to 4. Again, these are all very depends on your on individual, how comfortable are they in terms of their risk taking and your profit taking opportunities, and also depends on your winning rate as well. So there's a lot of factors that's being involved. Can't really give you a direct answer to that, but keep in mind, ATR is a good way to start. And when you look at spread, sometimes you can actually push your reward slightly on a bigger range, slightly wider, because of the range of the market for spread generally is actually very low.
All right, thank you very much, David, for answering our participants' question. And please understand that due to time constraints, we may not be able to address all questions. Now it's about time to conclude today's webinar sessions. Now, once again, I would like to take a moment to share with you about our upcoming webinars, especially for those who may have missed the earlier announcement. The LRF Let's Learn Futures webinar series features a variety of topics scheduled every Tuesday evening from 8:30 to 10 p.m. We will be covering a wide range of content-packed and informative topics where you can gain practical knowledge about futures trading from our experienced speakers. So if you're interested in joining any of these sessions, simply scan the QR code to register for the topics that you'd like to attend. Once you scan the QR code, you will be directed to a page where you can access to our event calendar. To join our upcoming sessions, simply navigate to the Tuesday column so that you are able to find the webinar topics. Besides that, we also have the LRF online workshop. Now, this is tailored for those who are new to futures market. If you're interested to learn more about futures trading in detail, then this online workshop is definitely ideal for you. So you can take a picture or screenshot this page and register yourself after this webinar ends. And feel free to share this event with your friends and family who are also interested in futures trading. Because in this workshop, we will be guiding you step by step on how to kickstart your first futures contract. And please note that each session is limited to the first 50 online attendees, so be sure to register yourself quickly to secure your seats in both workshops. Once you scan the QR code, you will again be directed to a page where you can access to our event calendar. To find the online workshop, simply go to the Saturday column, click onto it and register yourself from there. For those of you who may have not already know that you can explore a derivative trading simulator in Bursa Marketplace, as this simulator allows you to engage in paper trading, helping you to familiarize yourself with using a futures trading platform. So it's a great way for you to learn and gain hands-on experience through this trading simulator. And finally, before we conclude this webinar session, allow me to introduce you to this Bursa Academy. This is a comprehensive one-stop e-learning platform where you can access all of the information and knowledge about stocks, futures, and other products that you can trade on Bursa Malaysia. You can access to Bursa Academy by scanning this QR code on your right or by searching for Bursa Academy on Google to find the link. You can visit to this site for more detailed information and resources. It's a valuable resource to enhance your understanding in trading in Bursa Malaysia. All right, we have come to the end of our webinar session today. Thank you, David.
Thank you
for sharing such an informative session with us. And to all of you who joined us, thank you for your participation. And we hope you found this webinar both informative and valuable. And I believe you have gained quite new insights about how you can do spread trading in Bursa Malaysia. So with that, I'm CY signing off for now. Enjoy the rest of your day. Have a great evening. And until next time, bye-bye.